I'm Kyle Figgs, founder of ChartForecaster.com. In today's video, this is going to be the first part of a long series to help traders understand everything from really candlestick anatomy, patterns, Fibonacci, Heikin-Ashi candles, Ichimoku clouds, Wyckoff accumulations, and harmonic patterns. So if this is interesting to you, subscribe and stick around because we're going to be dropping a lot more of these tutorial style videos. But before we touch patterns, indicators, Fibonacci, or anything advanced, we need to speak the language of price. Now, that language is called candlesticks, right? Candlestick, think of it as four parts. We've got an open, a high, a low, and a close, and that's it. Everything else is open to interpretation. The body tells you where price opened and closed for that session. If you're looking at a 1 hour chart, you're going to see a 1 hour candlestick. And the body will tell you where the price opened and closed during that 1 hour period. The wicks tell you how far price tried to move but got rejected. So every candle is a negotiation between buyers and sellers, simply testing boundaries. Now here's the first rule I want you to memorize. A candle is not a signal by itself. A candle is more like evidence. And evidence only matters when it happens in the right place. So when you see a candle, you're not asking, is it bullish or bearish? You're asking one of three questions. Where did this candle form? Is it at a major support or resistance level? Is it at a range boundary? Is it at a prior swing high or swing low? Or is it just in the middle of nowhere? 2. What story is the candle telling? Now, a longer wick near the support is a story of attempted selling that got absorbed and rejected. A long upper wick at resistance is a story of buyers pushing and then getting slapped down. A big body closing near the high is aggressive buying, and a big body closing near the low is aggressive selling. 3. What would prove this story wrong? This is the most important question. If a candle suggests a bounce at support, then a close below that support or break below the wick typically invalidates the idea. Now, let's talk about the most common candlesticks that you can use as a trader. Bullish engulfing. A bullish engulfing candle is when a body of a candle fully consumes the prior bearish body. It's not magic, it's just a momentum shift. But it only matters at a location, like the bottom of a pullback in an uptrend, or at the low of a range. Doji stars and indecision candles. Doji candles aren't reversal signals, they're warning that momentum is pausing. The next candle confirmation matters really more than the doji itself. To summarize candlesticks the right way, candles really do help you read acceptance and rejection. And they help you time entries, but they do not replace context, structure, or risk management. For the next segment, we're going to be talking about bullish and bearish chart patterns.